What's up everybody, I'm Jaspreet Singh, and now with the Fed raising interest rates for a second time, mortgage rates are going up even higher, making the cost of homeownership going up even more than what it is now. Now you'd assume that if the cost of homeownership is growing 10 times faster than wages like we're seeing happen right now, that we'd see an even smaller demand for buying homes. I'll show you the numbers in just a minute. But big banks essentially said, no, we don't want to lose out on the opportunity to make some big profits, so they pulled something out from their sleeves that we haven't seen in a little while. The infamous ARM or adjustable rate mortgage is making a big comeback now here in 2022. You gotta remember, banks are in the business of making money, and the way that banks make money is by making loans. So if it's getting more and more expensive for somebody to go out and get a 30-year fixed rate mortgage because, well, interest rates are going up, causing the mortgage rates to go up, well, that makes less people interested in going out and getting a 30-year fixed rate mortgage. But if you can go and see an adjustable rate mortgage with a teaser rate for the first 5 years, meaning you get a low interest rate for the first 5 years of your mortgage, well, that can get people excited. Because why would you want to pay the super high rate, the 5.5% for the 30-year mortgage, when you can get a much lower teaser rate for the first 5 years? Plus, it's not like banks carry the risk of somebody defaulting on their mortgage, because as soon as a bank makes a mortgage, they're going to package up the mortgages and sell it, so now the bank doesn't have to carry any of the risk. This is where things get really interesting, because let's say this right here is a bank. So a bank is going to lend you a home, and I'm going to draw you a nice mustache, or as we like to say it in my native language, Punjabi, a much, or for our female followers, I'm going to draw you a nice braid, or as we like to call a braid in my native language, Punjabi, a gut. You go out and you get a mortgage from the bank so you can go out and buy a home. Now, the bank is going to get all these loans, and then they're going to package up these loans, and then they're going to sell it to somebody like Fannie Mae, FM. Now, Fannie Mae is an organization that buys up all these loans from the banks, they chop it up, and then they either keep it or they sell out some of these securities as mortgage-backed securities. But the interesting thing is Fannie Mae, the organization that is buying all these loans from the bank, has said that they predict a recession is coming in 2023. However, they also said that although we might see a recession, they're not too worried about it because our housing market is so strong, so it will cushion the blow of the recession. So this organization, the organization that's buying up all these loans from the bank, says that we are going to see a recession in 2023. However, it's not going to be that bad because the housing market is so strong. However, these banks that are making loans are seeing mortgage applications drop because interest rates are going up. And so to combat this higher cost of getting a mortgage, they're now selling these people ARMs, adjustable rate mortgages, because that is more attractive, especially in the short term, because you can get into a mortgage with a much lower teaser rate, and then after a few years your interest rate is going to adjust. Here's what that looks like. You want to go out and buy this $500,000 home, and now you have two options. You have the 30-year mortgage or the 5/1 ARM. So the 30-year mortgage at the time of me recording this video is something like 5.5%, which means that if you put down 20%, which is $100,000, you're going to be financing $400,000. If you finance $400,000 at 5.5%, your monthly payment is going to cost you something like $22.70 a month. And remember, in both of these cases, you're putting down $100,000, so the down payment doesn't change and the price of the home doesn't change. But then the bank says, well, another option, instead of you getting this 30-year fixed, is you can do the 5/1 ARM, and then we can give you a 3.7% interest rate. Now, they don't advertise it as a teaser rate, but that's what it is, because this 3.7% teaser rate isn't what you get for all 30 years. It's 3.7% only for the first 5 years, and then your interest rate's going to adjust. But then what the bank says is, look, you can buy this home and only have to pay 3.7% right now, which means instead of paying $2,300 a month, you can pay $1,840 a month for the exact same home. Now, this is going to look a lot more attractive, but then there's something that you have to look at right here. This 5/1 ARM. What that means is after 5 years of you paying $1,840 a month, your payments are going to readjust, and they're going to readjust to what the market is. So if interest rates don't change, well, then your interest rates are going to go up to something around $2,200 a month. But if interest rates continue to go up, which is what the Federal Reserve Bank says that they want to do, they keep saying that they want to raise interest rates to fight inflation. If the Fed stays true to their word, I'm saying if because you never know what the Fed is going to do, but if the Fed stays true to their word and they continue to raise interest rates, which is what they say, which is what the government says, which is what everybody is saying that the Fed is going to need to do to fight inflation, that means in 5 years, we're not going to have 5.5% 30-year mortgages. Maybe it'll be 7%, maybe 8%, maybe 10%. I don't know, right? We don't know exactly what the Fed wants to do. We know that the Fed wants to continually raise interest rates multiple times in 2022. There's been predictions that the Fed is going to raise interest rates 5 more times in 2022. We've only raised it twice so far. And so if the Fed continues to raise interest rates in 2022 and 2023, and then 5 years go by and mortgage rates are significantly higher than where they are today, well, then your mortgage payment is gonna be a whole lot higher when it adjusts. Now, this is where everybody hopes that, well, I can just refinance at that point, and then I can just refinance and then lock in a 30-year mortgage. But let me also remind you that when you lock in the 30-year mortgage in 5 years, you're still gonna have to pay a higher rate, because if interest rates continue to go up, your mortgage rate is also gonna be higher. And then you're also banking on the fact that home prices will continue to go up, because what happens hypothetically if in 5 years home prices drop? If home prices drop and you don't have any equity in your home, or if you don't have a lot of equity in your home, well, then you might not be able to refinance, because banks are going to look at you and say, okay, you bought the home for $500,000, you have $100,000 worth of equity, but today your home's only worth $385,000. So if your home is only worth $385,000, now I know I'm ignoring the fact that over the next 5 years, you're going to pay down some of the principal, but not a lot over the first 5 years. But banks are going to look at you and say, we don't want to refinance you because it's too risky of a loan. So now if you can't refinance, if you can't make the higher payments, either you're going to be forced to sell at a loss, or that's what pushes people into foreclosure. This is exactly what happened during the 2008 crash. Banks were advertising these super low teaser rates with adjustable rate mortgages, because now you look at this, 3.7% is cheaper than 5.5%, but back then they never told you that your mortgage rate is going to readjust. Right now we're in an economic cycle where interest rates are going up. So if you're taking an ARM during a time where interest rates are going up, well, that means if things go as planned, when it comes time for your mortgage rate to readjust, you're going to have a higher payment. And if you cannot support that higher payment, either you're going to have to cut down your lifestyle, you're going to have to refinance if you're able to, or maybe you'll be forced to sell your home. Now, before I go any deeper into why people have been getting these type of ARM mortgages, if you do want to stay up to date on what's happening in the top finance and business world before I can even report on it, you need to check out Market Briefs. It is a free financial newsletter that I created. Every morning, my team is going to send you a breakdown of what's happening in the top finance and business news into a fun, witty, and easy to read email. Many people have told me that this is the only email that they look forward to reading every single morning. You are going to love it, I promise, and it's completely free. So if you want to join Market Briefs, it's free. I'll put the link to how you can do that down in the description below. The reason why adjustable rate mortgages are becoming so popular right now is because people are looking at home prices today. If that home is $500,000 today, they're saying, wow, I missed out on the opportunity to, one, buy this home at a discounted price, because last year home prices were significantly less. Between 2021 and 2022, home prices have gone up by around 20%, which means about a year ago, the same home with no modifications, no anything, was selling for $416,000. So with no extra modifications, no extra improvements, that same home from $416,000 is now selling for $500,000. And then on top of that, if you look at the mortgage rates, in 2021, you could get a 30-year fixed rate for 2.5%. Nowadays, it's around 5.5%, which means if you put 20% down, you would have only had to put down $83,000, almost messed up there. And in this case, you got to put down $100,000, assuming that you're putting down 20% in both instances. And so now, not only do you have to have a higher down payment, your monthly costs are so much higher because you're borrowing more dollars and you're buying the more dollars at a higher interest rate. Because 1 year ago, you could have got the same 80% mortgage for about $13.10 a month. Now it's costing around $22.40 a month. So yes, your down payment is 20% higher, the cost of the home is 20% higher, but your monthly payments are significantly higher. I just checked my numbers and I made a little bit of a mistake. It's not $2,240 a month, it's $2,270 a month at the 5.5% mortgage. So what that means is not only do you have a 20% increase here on the purchase price, now your monthly costs are about 70% more. A 70% inflation on your monthly costs because your mortgage costs are higher and the amount of dollars that you have to borrow is higher also. So if you remember in the beginning of this video, I talked about how now your cost of home ownership is 10 times higher than the growth of our wages. Well, over the last year, between 2021 and 2022, let me actually put this on blue marker. Wages over the same course have gone up by under 5%. I'm going to be generous and say 5%, but it's been less than 5% on average across the country. So let's just say wages gone up by 5% across the country versus the cost of home ownership, your monthly cost is 70% higher. So your cost of home ownership is growing significantly faster than your wages, and unless your wages are going to grow by 70% between now and I guess now, well, the cost of homeownership is growing significantly faster than wages. So if you really want to be a homeowner, you're looking at this and you're saying, is there any alternative options? And that's where the bank's going to say, yes, there is. We have this thing called the adjustable rate mortgage, where then you have a significantly lower mortgage rate. Instead of 5.5%, you're paying close to 3.5%, although it's not as low as where it was back in 2021. It's still significantly lower than where it is here, but the risk with an adjustable rate mortgage is when interest rates go up, your monthly payments will go up as well, because it's not a fixed rate mortgage. So make sure you understand this risk. Adjustable rate mortgages are extremely risky. They are extremely dangerous in times when interest rates are going up and you do not predict or you are not ready for higher monthly payments. If you say, okay, I'll take an adjustable rate mortgage because I'm going to pay off my home in the first 4 years or in the first 5 years, fine. But you better be sure that you can pay off your mortgage in the first 4 or 5 years. That way you can take advantage of these lower interest rates, because if interest rates continue to go up, well, then you have the higher monthly payment. So you're kind of gambling because you're betting, hopefully, that interest rates are going to go down in 5 years, which is why you would take an adjustable rate mortgage, because then when it readjusts, your payments will go down. But right now we're in an economic cycle where interest rates are going up and we don't know when they will go down. Now I know there's a lot of questions as to what the Fed is going to do. Are they going to cut rates if we go into a recession? If more supply chain issues happen, if we see more pandemic issues, are they going to cut rates? But it's a gamble, and I would not want to be gambling with the livelihood of myself and my family, especially if this is my biggest cost on an adjustable rate mortgage. So be smart here, and if you really want to be a homeowner, look for alternatives. That means look for a home outside of where you're looking right now so you can find cheaper homes. Work to save up more money, work to earn more money. Maybe that means getting a promotion at your job or working a side hustle, getting another job. Look for alternatives. That way you don't stretch yourself too thin, because you don't want to put yourself in financial danger if and when mortgage rates readjust and they're a lot higher than where they are now. If you enjoyed this video and you want to see my full breakdown of why housing affordability is about to get worse, I made a video covering it and you can watch it by clicking that button right over there. Thank you for watching, and as always, keep hustling. More money isn't the solution to every problem, but it is the solution to a problem where you can't afford something, and this is where you have to understand there's a lot of money in the world.